Hello friends, with respect to our last video, we have discussed about section 17, apportionment of credit, and read with rule 42 and 43, that is input tax credit availment or apportionment in case of inputs and input services and capital goods. Rule 42-43 we have discussed, and also few illustrations we have discussed. Now we are proceeding with section 17 subsection 4, special provision for availment of ITC by a banking company and a financial institution including NBFC. For a bank or a financial institution or an NBFC, there are two types of income: interest income and other income. Interest income is exempted, other income will be taxable. See, interest income, why it is exempted? Because we have one exemption. What is that? Any consideration represented by way of interest or discount on loans, advances and deposits is exempted. So under that point it is exempted. And all other income, by whatever name called, because a bank will be having lot of other incomes now, multiple charges they are levying, like debit card charges, credit card charges, this charges, that charges, like that they are levying. So with respect to all the charges, GST is payable, and that is the other income. So interest income is exempted and other income will be taxable. So therefore, whenever they receive some inward supplies, input services or inputs or capital goods, whenever they have some inward supplies, specifically towards the taxable supply or specifically towards the exempted supply cannot be identified. So all majority are common. So when they take inward supply related to, say, renting of immovable property, so we cannot say that that is only to the extent of other charges. That may be for the rent, that rent whatever they have paid may be for interest income, generating interest income also. Therefore, the income of a bank which is divided into exempted supply and taxable supply. So interest income is exempted and other income will be taxable. So the inward supply with respect to exempted supply, you cannot take ITC, and inward supply with respect to taxable supply, you can take ITC. So when it is common, you need to take proportionate credit, and that proportionate credit will be in terms of rule 42 and rule 43, and that is regular option. Option 2 is what? Option 2 is what? 50%, avail 50% of the eligible ITC. That is ad hoc basis. So here what is the assumption? The assumption is that 50% is interest income and remaining is the other income. So that's the assumption here. That is with respect to option 2. Now when I will go for option 1, suppose if my interest income, when I will go for option 1, when my interest income is greater than 50%, I will go for option 1. Why? Because if my interest income is greater than 50, if my interest income is less than 50%, I will go for option 1, because I will be eligible to take more. And here what is the assumption? 50% is the interest income. So if my interest income is less than 50%, I should go for option 1. Then only I will be enjoying more ITC. Suppose if my interest income is greater than 50%, if my interest income is greater than 50%, I should go for option 2, because under option 2, the interest income is taken as 50%. And what will happen to the remaining 50%? Remaining 50% of the ITC will be lapsed. And this restriction of 50% shall not apply to tax paid on supplies made to another registration within the same entity. What does it mean? Now, I have some inward supply from a distinct person. That is, I am a branch which is located in Tamil Nadu. I receive services from another branch which is located in Karnataka. So, transaction between distinct person. And in that case, that is my inward supply. Can I take full ITC whether I need to reverse any 50%? No, I can take full ITC. I don't have to reverse any 50%. What if I go for option 1? And option 1 I have to take proportionate. But in option 2, generally I take 50%. With respect to inward supply from a distinct person, I don't have to reduce 50%. I can enjoy full credit. And this option, once exercised, cannot be withdrawn during remaining part of the financial year, which means in the beginning of the financial year, I need to decide in the beginning of the financial year, I need to decide whether to go for option 1 or option 2, and once I have decided, that option shall remain for all transactions or during the financial year, which means month 1 option 2, month 2 option 1, like that I cannot go. That is with respect to 17 subsection 4. With this, section 17 is over. We already completed blocked credits, and in that blocked credits, I think we need to discuss, we have completed, yes, blocked credits, the remaining portion we have completed, and now we are proceeding to input tax credit in special circumstances. Section 18, section 17 we have completed, and section 18, input tax credit in special cases. Section 18 subsection 1 talks about availment of ITC on closing stock. There is some closing stock. On that closing stock, the GST paid can be taken as ITC. And which date closing stock, or what is that situation? We have multiple situations here. Situation number 1, 18(1)(a), person applying for registration within 30 days of becoming liable for registration. With effect from one date, say I am liable to get registered, and I make application for registration within 30 days. So what will be the effective date of registration? The date I am liable to get registered. Now, before that date, I would have made some inward supplies which is in the closing stock, and that closing stock will be used for making outward supplies after the date I am liable to get registered. Therefore, at the time when I purchased it, I cannot take ITC because I am an unregistered person. But that closing stock will be used for making outward supplies thereafter, right? So therefore, I can take the ITC with respect to the closing stock. So which date closing stock? What is the first situation? Person applying for registration who is liable to get registered within 30 days, he is making application for registration. Which date closing stock we need to take? On the day immediately preceding the date from which he becomes liable to pay tax. And next, person obtaining voluntary registration. Next situation. Now, which date closing stock should be taken? Immediately before the date they get the registration certificate. So that date, whatever is the closing stock, that should be taken on the day immediately preceding the date of registration. And then 18(1)(c), a registered person who is switching from composition levy to regular scheme. So composition scheme to regular scheme. When that person was under composition scheme, he would not have taken ITC, and that will be in the closing stock, which will be used for making outward supplies during the regular scheme. So therefore, before the date of migration, whatever is the closing stock, that should be taken, and on that GST paid can be taken as ITC. Then a registered person outward supply was taxable, was exempted. Now it has become taxable. Now at the time when his outward supply was exempted, he would not have taken ITC. Now when his outward supply become taxable, when his outward supply was exempted, he would not have taken ITC. Now when the outward supply is taxable, he can take ITC with respect to the closing stock as on the date before, when exempted supplies have become taxable supply, on the day immediately preceding the day from which such supply becomes taxable. These are the 4 situations. So what are the 4 situations? 18(1)(a), 1(b), 1(c) and 1(d). 1(a), that is liable to get registered and made application for registration within 30 days. 1(b), voluntarily you got registered. 1(c), remember C for composition scheme to regular scheme. 1(d), exempted supplies have become taxable supplies. Now, which date closing stock we need to take? 1(a), before the date you are liable to get registered. 1(b), before the date you get certificate of registration. 1(c), before the date of conversion from composition scheme to normal scheme. 1(d), before the date when exempted supply become taxable supply. Now, what is the meaning of the closing stock? For 18(1)(a) and 1(b), we need to take raw material lying as such, and then WIP in the closing stock and its raw material. Then FG in the closing stock and its raw material. So these 3 raw materials, whatever GST paid, can be taken as ITC. What are the 3 raw materials? Raw material lying in the closing stock, raw material in WIP which is in the closing stock, raw material in FG which is in the closing stock. With respect to these 3 raw materials, GST paid can be taken as ITC. Then what about 18(1)(c), 1(d)? There what is the meaning of closing stock? Same. These 3 are there even in that place. And extra we have one special case that is capital goods. So in 18(1)(a)(1)(b), I cannot take in the closing stock capital goods, but in 1(c)(1)(d), I can take in the closing stock capital goods, and in that capital goods, full GST paid cannot be taken as credit. On raw material, whatever GST paid, I can take as credit. But on capital goods, whatever GST I have paid, I cannot take as credit. I need to reduce 5% for every quarter or part thereof. That we discussed while discussing Rule 43. I told you when CG1 and CG3 become CG2, we need to reduce 5% for every quarter or part thereof. You remember that logic? Same way. So here, I need to take when the capital goods are purchased and reduce 5% for every quarter or part thereof with respect to the GST paid. Now I will get the ITC, and that ITC I can take under 18(1)(c) and 1(d). Then another special point in 1(c) and 1(d) is that in case of 1(a), 1(b), whatever ITC that you take on the closing stock need not be matched with the supplier's invoice. So it need not be reported in supplier's GSTR1. Whereas if you want to take ITC under 18(1)(c) and 1(d), that ITC if you want to take, then that should be reported as liability in GSTR1 of the supplier. So matching is there. ITC claimed shall be verified with the corresponding details furnished by the corresponding supplier. So that's a very important point. Whatever ITC that is claimed shall be verified with the corresponding details furnished by the corresponding supplier. Then, so therefore, what this person should do, even though when he was under composition scheme or he was making exempted supply, even though he was under composition scheme or he was making exempted supply, he should ensure that he is purchasing from a person, registered person, who shows that supply as B2B. Now that registered person will ask, your registered supplier will ask, anyhow you are under composition scheme or you are making exempted supply, what is the need of classifying it under B2B? But you need to tell, idiot, you classify it under B2B, because tomorrow when I am required to take ITC, I will not be in a position to take ITC because matching is there. So therefore you should ensure that that person, supplier, classifies it under B2B supply in his return. Then, now 18 subsection 2 says, whatever the closing stock that is there, if you want to take ITC, that closing stock should have been purchased within 1 year prior as on the date of closing stock. As on the date of closing stock, it should have been purchased within 1 year prior. Then only, means the date of invoice should be, the date of invoice to the date of closing stock should be within 1 year. Then only you can take the ITC. Sir, is it applicable even for capital goods? Actually speaking, this should not be applied to capital goods, but on literal interpretation, this 18 subsection to 1 year time limit is applicable even in case of capital goods. Then, how can I take this ITC? Should I report it in GSTR 3B? No, the procedure is completely different. I need to file ITC 01, a declaration. If I want to take ITC on closing stock under 18 subsection 1, within the time limit under 18 subsection 2, I need to file a declaration. What is a declaration? Form GST ITC 01. What is the time limit? Within 30 days from the date when I am eligible to. Under 18(1)(a), when I am eligible to, the date I am liable to get registered, I get the registration certificate. That date I am eligible to take the ITC. Voluntary registration, the date when I get registration certificate. 18(1)(c), when I migrate from composition scheme to normal scheme, and 18(1)(d) when my exempted supply become taxable supply, from the date within 30 days. What if I am not able to file within 30 days? Such further extended time limit by the commissioner. Then next, this declaration shall be certified by a practicing cost accountant or a chartered accountant if the claim exceeds 2 lakh rupees. If the ITC claim exceeds 2 lakh rupees, that should be certified by a practicing CA or a CMA. Then look into next one, 18 subsection 3, transfer of ITC. Transfer of ITC arises in two situations. Situation number 1, when there is transfer of business, and situation number 2, when single registrations get segregated into multiple registration. What are the two situations where 18 subsection 3 is applicable? Situation number 1, transfer of business. Situation number 1, transfer of business from one person to another person. And situation number 2, single registration becoming multiple registrations. Single registration becoming multiple registrations. Single registration becoming multiple registrations. So in these two cases, transfer of business and single registration becoming multiple registration, in these two cases 18 subsection 3 is applicable. What is transfer of business? You can understand. That is, I have a business and I am transferring it to another person, that may be by way of merger or demerger, amalgamation, sale, whatnot, anything. Then when the single registration becomes multiple registration within the state, when I have multiple place of business. Say I have 4 places of business in Tamil Nadu, Chennai, Coimbatore, Madurai and Erode. Like this, in 4 places I have business, 4 places of business. And I opted for single registration by showing Chennai as my principal place of business and other 3 places as my additional place of business. So I therefore in Tamil Nadu I have only 1 registration. Now I decided to go for separate registration in Tamil Nadu, 4 registrations. So that single registration is becoming 4 registration, and in that case when single registration becomes 4 registrations, so what should I do? That is, that single registration will have some ITC that will become 4 registrations. So the single registration, whatever ITC is there, that ITC will be distributed to the 4 registrations. That single registration ITC, whatever is there, that will be distributed to 4 registrations, and that will be in what ratio? That will be in the ratio of assets of those 4 registrations post registration, as on the date of registration. When single registration gets separated into 4 registration, as on the date of registration, whatever is that net assets, in that ratio the ITC of the single registration will be distributed. Same way in case of demerger. When AB Limited gets demerged into A Limited and B Limited, AB Limited, whatever ITC is there, that will be distributed to A Limited and B Limited on the assets ratio of the A Limited and B Limited post demerger. See this. In case of demerger, credit shall be transferred to the new entities in the ratio of the net assets. But when you take the net assets, don't take only those assets on which ITC is availed. You take the all assets, whether ITC is availed or not on that assets, you take all those assets. So whether ITC is availed or not, such assets are post demerger. In case of merger of 2 companies into a single company, the problem is not there. A Limited and B Limited gets merged into AB Limited. Now whatever is A Limited's ITC, that will go to AB Limited. Whatever is B Limited's ITC, that will go to AB Limited. Now how this ITC will be transferred? It will be transferred, the transferor in case of transfer of business should file a form GST ITC 02. So that should be accepted by the transferee, and the unutilized credit in the electronic credit ledger of the transferor shall be transferred to the electronic credit ledger of the transferee. Whereas in case of single registration becoming multiple registration, the form number is ITC 02A, capital A. In this case, that is, in the first case it is ITC 02, and in the second case the form number is GST ITC 02A. So that should be taken as the form number. Then we have 18 subsection 4. What does 18 subsection 4 says? It is discussing about the situations which is opposite of 18(1)(c) and 1(d). What is 18(1)(c)? When I am into composition scheme and I am going into normal scheme. I am under composition scheme and I will be going into normal scheme. That is 18(1)(c). Whereas 18(1)(d) is what? Exempted supplies becomes taxable supply. That is 18(1)(d). So 18(1)(c). You are under composition scheme. Now you are going into normal scheme. And what is 18(1)(d)? 18(1)(d). You are making exempted supply. Now your outward supplies have become taxable. Now its opposite is 18 subsection 4. In these two cases, what we did? We availed ITC on closing stock. Avail ITC on closing stock. Now there is a reverse scenario. What is that reverse scenario? You are under normal scheme. Now you are switching from regular scheme to composition scheme. So normal scheme to composition scheme. Same way, a person's taxable supply is getting wholly exempted from tax. So 18 subsection 4 is opposite of 18(1)(c) 1(d). In 18(1)(c) 1(d), what you did? You availed the ITC on closing stock. Now it is an opposite, reverse. So you need to reverse the ITC on closing stock. So in 18 subsection 4, what we will do? Reverse the ITC on closing stock. Now what is this 29 subsection 5? Whenever there is a cancellation of registration, at the time also, whatever is the closing stock, on that the ITC gets reversed. So the treatment being the same for 18 subsection 4, whatever is the treatment, the same treatment is under 29 subsection 5. So it is being integrated in one place. So 18 subsection 4, two situations. What are those two situations? Normal scheme to composition scheme. And taxable supply has become exempted supply. Read with 29 subsection 5. Third situation, cancellation of registration. In these three cases, what will happen? We need to reverse the ITC on closing stock. Means we will be adding it to the liability. Whenever we reverse, what will happen? We will be adding it to the liability. And what is the amount to be reversed? What is the amount to be reversed? Very simple. Take the closing stock. Same way. Take the closing stock. Raw material. Whenever it is purchased. Time limit we have now 18 subsection 2, that is not applicable for 18.4. For 18 subsection 2, time limit is applicable for 18 subsection 1, not applicable for 18 subsection 4. When we are taking ITC on closing stock, it should be purchased within 1 year. But when we are reversing ITC on closing stock, it can be purchased anytime. So what if it is purchased before GST regime? At that time, through Tran 1, the credit would have been transferred. So therefore, that ITC you take. So anytime it would have been purchased. So take that ITC on the raw material which is in the stock. Then identify WIP. On the WIP, whatever is the raw material content, that raw material content, whatever is the ITC that you take. Then find the finished goods content. In that, what is raw material? That raw material, whenever it is purchased, ITC. So these three ITC. So in the closing stock, RM, WIP, FG. RM in WIP, RM in FG. So these three RMs, whatever ITC you have taken, that should be added, that should be reversed. Plus capital goods, because in 18.1C 1D we have capital goods also now. So therefore reversal with respect to capital goods also will arise. And in that case of reversal with respect to capital goods, what is that we need to do? Should we reverse the entire ITC pertaining to capital goods? Not required. We don't have to reverse the entire ITC pertaining to capital goods. We should take ITC on the capital goods divided by 60 months into balance useful life. That should be reversed. So total ITC on capital goods divided by 60 months into balance useful life. So that much of credit related to that capital goods needs to be reversed. So now I need to reverse 4. These reversed amount, what I will do, I will add it to the liability. If I already have that much of credit balance, it will get adjusted from the credit balance. What if I don't have the credit balance? I need to pay. Now, so therefore, this payment shall be made using electronic credit ledger or electronic cash ledger. If I have balance, electronic credit ledger. If I don't have balance, electronic cash ledger. I have used the electronic credit ledger. Still there is some balance in electronic credit ledger after reversal. What will happen with respect to that balance? Can I carry forward? No, it will be lapsed. Balance ITC, if any, will be lapsed. That is with respect to this. Now, with respect to these inputs, what if I don't have the purchase invoice? Because I purchased it long back, so I don't know how much ITC I have taken. Don't worry, you take the market value as on this date. Which date? The date when you are identifying the closing stock. On that date, whatever is the market value of that input, you take that market value, multiply with the GST. It's better to create the invoice or get the invoice. And whenever you go for market value, that should be certified by a chartered accountant or cost accountant. Not always, only instead of invoice, when you go for market value, that will be certified by a chartered accountant or cost accountant. And here, to reverse this ITC, we will be filing a form called as ITC 03. ITC 01 is for what? Availment of ITC on closing stock. ITC 02, transfer of ITC. ITC 03 is for reversal of ITC pertaining to the closing stock. Then capital goods reversal on pro rata basis. This is with respect to 18 subsection 4 read with 29 subsection 5. And we don't have 18 subsection 5, that is like we have, but that is just reference to the rules. And then 18 subsection 6. When 18 subsection 6 is applicable, I have some capital goods on which ITC is available. That's very important. I have some capital goods on which ITC is available and I am transferring that capital goods. So supply of capital goods on which ITC is available. If there is supply of capital goods on which ITC is not available, this 18 subsection 6 is not applicable. So when 18 subsection 6 is applicable, there should be supply of capital goods, and on that capital goods ITC should have been availed. Now, what should be taken as the GST payable? Number 1, so much of the ITC availed as reduced by 5% for every quarter or part thereof. From when? From the date of purchase, that is invoice, till the date of sale, supply. So for that period, every quarter or part thereof, 5% should be reduced. For example, you purchased on 1/4/2019 and you sold it on 31st March 2020. So one full year, 4 quarters, so 4 into 5, 20%. Take the original ITC, reduce 20% remaining ITC, or GST on sale value, whichever is higher should be payable, whichever is higher. So much of the ITC as reduced by 5% for every quarter or part thereof from the date of invoice till the date of sale, or GST on sale value, whichever is higher is what I need to pay. Then in case of refractory bricks are bricks which are used for the purpose of construction of ovens in a factory. Refractory bricks, molds and dies, jigs and fixtures. These three: refractory bricks, molds and dies. Molds and dies are used to bring the required shape. Product, if you need to bring it into a required shape, we use molds and dies. Then jigs and fixtures, to hold the materials. We use jigs and fixtures. These three sold as scrap. Then only point number 2 is applicable. What is point number 2? Take the GST on sale value. That point is only applicable. Suppose if you sell these three not as scrap but as regular second-hand goods, then 1 or 2, whichever is higher. Only when you sell it as a scrap, only point number 2, that is GST on sale value, that is applicable. So this is with respect to 18 subsection 6. So with this, we completed section 18 here. So section 16, conditions for availment of ITC, section 17, apportionment of credit and blocked credit, and section 18, that is input tax credit in special cases. Now, before moving on to section 19, 20 and 21, we will see one illustration. So have a look into these questions for practice. I think already 3 questions we have completed, and now we are proceeding to the other questions. So question number 3. I think question number 1 and 2 we have completed. Look into question number 3. Question number 1 and 2, yes, we have completed, and we need to start because this alpha, beta, gamma, I remember discussing that we have completed. Look into question number 3. Question number 3 is pretty bigger one here. So you should be having patience in reading this question. So it is like a case study type question, wherein the question itself will run into multiple pages and lot of computations are involved in this question. Have a look into this. B&D Company, a partnership firm in Nagpur, Maharashtra, is a wholesaler of taxable product P and exempted product Q. See, we will try to understand the question then and there. So therefore, I will be spending more time on elaborating the question. And first, we will be understanding the question and its repercussions also we will be trying to understand. Therefore, so reading this question is very important. So where there are 2 products which are manufactured by this company, B&D Company. What are those 2 products? P and Q. P is a taxable product and Q is an exempted product. The firm supplies these products only in the eastern part of Maharashtra. They are also located in Maharashtra. They are also making supply in Maharashtra, which means it is an intrastate supply chargeable to CGST and SGST. All the procurements of the firm are from the suppliers registered under regular scheme in the state of Maharashtra. Therefore, inward supplies is also CGST and SGST only. The firm pays tax under composition scheme. So that's an important highlight to be made. The firm pays tax under composition scheme. So current year they are opting for composition scheme. B&D Company has furnished the following details with respect to its turnover exclusive of taxes and stock exclusive of taxes. So what is their turnover for the first quarter in the current financial year? First quarter, what is their turnover? P and Q, 60 lakhs and 17 lakh 65,000. That is the turnover for the first quarter, Q1. And for the second quarter, Q2, their turnover is 50 lakhs and 17 lakhs. So whether they cross a turnover of 1 crore 50 lakhs, because when a person is under composition scheme, up to what turnover they can be under composition scheme? 1 crore 50 lakhs. That too they are in Maharashtra, not 8 special category states. If it is 8 special category states, 75 lakhs, but they are in Maharashtra here. So which means 1.5 crores or 1 crore 50 lakhs will be, or 150 lakhs will be the limit, and thereafter they cannot continue in the composition scheme. They need to come out of the composition scheme and go into normal scheme. Now here they are under composition scheme or not? Yes, they are under composition scheme from the beginning. And what is their turnover? So can you total this? When you take the turnover, you need to take even exempted supply also. So if you total this, it comes to what? 60 plus 50, 110, 110, 120, 130, and then 1 crore 44 lakhs 65,000. Correct? 1 crore 44 lakhs 65,000 is their turnover. So they are still in the composition scheme for these 2 quarters. Next, particulars: stock as on 36, stock as on 39, stock as on 31/10. So they have given the stock details for the quarter 1, quarter 2, and in quarter 3 first month. In the quarter 3 first month, that is October month, they have given the stock details. The entire stock of product P and Q available in the firm as on 39 is purchased during the said half year, except a consignment of product P valuing 3 lakhs. So out of this 10 lakhs, 3 lakhs is purchased in the April month of the preceding financial year. Means it is not purchased within 1 year. So all this 7 lakhs, out of this 10 lakhs, 7 lakhs is purchased within 1 year and 3 lakhs is purchased beyond 1 year. So that's what they are trying to say. In the current financial year, in the month of October, no purchases were made. So that is also an important clue. They have not made any purchases. So if you want to know the sales, like sales, if you want to know the cost of production, or if you want to know sales, so this detail will be useful. So there is only opening stock, closing stock, and there is no purchases. And the products were sold with a profit margin of 20% on sales. So it is 20% on sales. Suppose if I need to get it on cost, so what is the profit margin? The profit margin is 20% on sales. If I need to get it on cost, what should I do? I should be taking 20 divided by 80. 20 divided by 80. See, 20% on sales. If sales is 100, profit is 20. If I need it on cost, cost is 80. So 20 by 80. So that will be on cost. On cost, it will be 20 by 80. Then the extract of the only bill book maintained by the firm showed the following details. So for which month they have given the details? For the October month they have given the details. Now if you look into their turnover as on the second quarter, it is 1 crore 44 lakh 65,000, and if they cross 1 crore 50 lakhs, they are ineligible for composition scheme. Means still what is the cushion they have to make supplies in the October month? So it is 5 lakh 35,000. This is the balance. This is the balance they can make in October month, so that still they will be into composition scheme. Now we have got the October month detail. So in October month, it is 2,03,000. So P and Q. So we are finding on which date they are going to cross 1 crore 50 lakhs. Now already they are in 1 crore 44 lakh 65,000. So now what is the limit? 5 lakh 35,000. So here 2,03,000. 2,03,000. Now to this 2,03,000, we need to add 1,38,250. So 2,03,000 plus 1,38,500, that is 3,41,500 plus 1,06,250, that is 4,47,750. So what is the deficiency? Like 5,35,000, still 5,35,000 they can make, and they will be in composition scheme, plus 92,500. So 5,40,250. So therefore they are crossing 1 crore 50 lakhs. See, 5 lakh 35, but it is 5 lakh 40,050. They are crossing 1 crore 50 lakhs. They are crossing 1 crore 50 lakhs on which date? 310 they are crossing. 310 they are crossing. So we need to take closing stock as on before date. So this should be taken as the closing stock date, because if you want to take ITC, you are under which scheme? Composition scheme. You are going into normal scheme. So which section? 18(1)(c), composition scheme to normal scheme. So immediately before the date when you are converting from composition scheme to normal scheme, what is the date on which you will be converting from composition scheme to normal scheme? 3rd October, because on that day you are crossing 1 crore 50 lakhs. So which means before the date, that is 210 will be taken as the closing stock date. So this should be taken as the closing stock date. Closing stock date for 18(1)(c) is 210. As on this 210, whatever is the closing stock, on that GST paid can be taken as credit, provided it is purchased within 1 year. Even on capital goods also we can take. Now, proceed further. The details of services availed by B&D company is as follows. Can they take ITC with respect to input services? No, they cannot take ITC with respect to input services, but the input service details are given in this. Freight paid to goods transport agency during the period April to October. Assume equal amount of freight is paid each month on the 10th day of each month. Also assume that the goods for which the freight is paid on 10th day of the month are transported between 11th to 20th day of the month. 1,40,000. So what is that they are telling? From April to October, every month they are incurring some charges. The total is 1,40,000. So April to October means how many months? So it is April, May, June, July, August, September, October, 7 months. So which means divided by 7 when you do, per month it will be 20,000. And assume equal amount of freight is paid each month on the 10th of each month. So by 10th of each month we are paying it. Also assume that the goods for which freight is paid on 10th day of the month are transported between 11th to 20th day of the month. Then special packing charges paid to a packing company having expertise in such specialized packing. So they outsource the packing charges, packing cost. So January to October, 10 months. So divided by 10, so monthly it is 30,000. And the packing charges are paid for the goods which are transported between 11th to 20th day of the month. As mentioned in point number 1 above, the goods are packed on 10th day and then transported from 11th day onwards. Assume equal amount of packing charges are paid each month on the 9th day of each month. All the above amounts are exclusive of taxes wherever applicable. Now, this is the question. Compute ITC credited to the electronic credit ledger of B&D company when it exits composition scheme. So they are coming out of the composition scheme and going into normal scheme on which date? 310. So we need to take the closing stock as on 210 and becomes liable to pay tax under regular scheme in accordance with the provisions of section 18(1)(c) of the CGST Act. Following additional information is also available. So what is that additional information that we have? Look into the first one. Computers purchased on 1/2. What is the closing stock date? The closing stock date is 2/10 and 1/2 is within 1 year or not? Yes, within 1 year. So can we take ITC with respect to this? Yes, but of course we need to reduce 5% for every quarter or part thereof. So when it is purchased 1/2, so 1/2 means February month. So Jan, Feb, March, April, May, June, July, August, September, in October 2 days. Therefore, we need to take 4 quarters. So minus 4 into 5%. Whatever is the GST minus 4 into 5%, that much can be taken. So what is that? We will calculate here itself. So 4 into 5 is 20%. So 36,000 minus 20% if you take. So the balance is 28,800. That is the ITC with respect to computers. Then that is under 18(1)(c). 18(1)(c), how much ITC we can take? 18(1)(c), how much ITC we can take with respect to computers? 28,800. Then printers, January 1st, 2 years prior to 1/1. See, for 18(1)(c), can we take this credit? No. it should be purchased within 1 year. Then only we can take this ITC. Motorcycle used by the staff for collecting payments from debtors 23/9. Is it within 1 year? Of course, within 1 year. And as on 2/10, it is 23/9 within 1 year as on 2/10. So can we take the ITC? Of course we can take ITC. You don't make the mistake. First of all, motorcycle is in blocked credits. Motorcycle is in blocked credits. Motor vehicles having capacity to transport passengers less than 13. So motorcycle will come into that. And what is their business? They are into trading business. So trader cannot take ITC with respect to motorcycle purchase. It is not stock in trade. They are not selling motorcycles. They are selling some products. So therefore it is not stock in trade. Second point is what? Used in the business of transportation of passengers? No. And third point is what? Imparting driving skills? No. Therefore they cannot take this ITC with respect to closing stock, like with respect to motorcycle. So leave it. Furniture and fixtures purchased on which date? 12/6. Is it within 1 year? Yes. And can we take this ITC? Yes. But we need to reduce 5% for every quarter or part thereof. So June. So April, May, June 1 quarter, July, August, September, and October 2 days. So therefore 3 quarters minus 3 into 5%, that is 15%. So take 72,000 minus 15%, you will get 61,200. That is the ITC. Then air conditioner used in office. Can we take ITC with respect to the air conditioner used in office? Yes. 15/10 it is purchased. So it is not purchased before the date of closing stock. It is purchased in the month when they are under normal scheme. So this they can take as regular ITC. They can take as regular ITC and not under 18(1)(c). Not under 18(1)(c). As regular ITC itself they can take. So they don't have to take it under 18(1)(c). Regular ITC itself they can take. That too in the month of October they can take. So therefore we are not taking it now. Exhaust fan used in the godown. 10/3 it is purchased. Is it within 1 year? And exhaust fan anywhere in the block credits? No. And it is purchased on 10/3. So is it purchased within 1 year? Yes. So Jan, Feb, March, then April, May, June, July, August, September, and October 2 days. So 4 quarters minus 4 into 5%, 20%. So 9,000 minus 20%, balance 7,200. This is the ITC on capital goods that can be taken. 28,800, 61,200 and 7,200 under 18(1)(c). With respect to raw material, we have not yet found. We need to find. Note, make suitable assumptions wherever required. Rate of CGST and SGST on service of transportation of goods by GTA is 2.5%, which means with respect to this freight, they will be paying GST under RCM. Correct? So make suitable assumptions. Rate of CGST, SGST on service of transportation of goods by GTA is 2.5%. Nowhere it is given that GTA is paying GST under FCM, which means RCM is applicable. Stock is valued at cost price. Note, the company has not claimed depreciation on tax component of any capital goods, which means condition is satisfied, they can take ITC. All the conditions necessary for availing the ITC have been complied with. Rate of CGST and SGST. So what is the rate at which they pay CGST, SGST? 9%, means 18% is the rate that is applicable. And even on inward supplies also, that will be the rate that is applicable. Now, this is the question here. Now, what is that you need to do? We need to find how much ITC we can take under 18(1)(c). Very simple. Capital goods already we calculated. What is that credit that we can take on capital goods? 28,800, 61,200 and 7,200. This is the credit that we can take on capital goods. Under 18(1)(c), we can take credit on capital goods after reducing 5% for every quarter or part thereof, and that capital goods should be purchased within 1 year from the date of purchase till the date of closing stock date. So we need to reduce, and we did. Now we need to take raw material as such lying in stock. Then raw material in WIP, raw material in FG. So we don't have any raw material data, but we have only FG data. And finished goods, we need to take stock. We have some stock details, that is directly we have some stock details, and that stock, whatever is the GST paid, that will be taken. So here, what is the stock as on the closing stock date. How to find that? So what is this closing stock date? 2/10. 2/10 is the closing stock date. As on the closing stock date, as on the closing stock date for 18/1, what is the stock that we need to find here? And here, with respect to stock as on 39, stock as on 39, that is 10 lakhs. Stock as on 39, that is 10 lakhs. Out of this 10 lakhs, with respect to 3 lakhs, we cannot take because it is purchased beyond 1 year prior. So we can take only with respect to 7 lakhs. We can take only with respect to 7 lakhs. On this 2 lakhs, anyhow it is an exempted product. So we would not have paid any GST because with respect to Q, whatever is purchased, that is also exempted. That is an assumption. Then with respect to this 1,20,000 also, the point will not arise. This is a stock as on 31/10, but we need the stock as on 2nd October. Now 2nd October, you take PQ, the P 2 lakhs, 1,33,000 and 67,000. This is the sale price. On sale price, if you reduce the profit margin 20%, you will get the cost. So on sale price, if you reduce the profit margin, you will get the cost, and that will be the cost as on, like that will be there in the stock as on 2/10. So you need to take 2 lakhs plus 1,33,000 plus 67,000 and you need to reduce 20% so that you will be getting the stock as on 2/10, and that detail you can see in the answer. See here, stock as on 39, out of that 10 lakhs, that is, what is the opening stock? I need the stock as on which date? Opening stock plus purchases. Opening stock as on which date? 1/10. Opening stock as on which date? 1/10. Opening stock as on which date? 1/10. And plus purchases minus cost of goods sold equal to opening stock plus purchases minus cost of goods sold equals to closing stock as on which date? 2/10. As on which date? 2/10. Now, what is the opening stock? P only, with respect to P only, 10 lakhs. What is the opening stock? 10 lakhs. Purchases 0 minus cost of goods sold. From 110 to 210, how much we sold? From 110 to 210, how much we sold? From 110 to 210, how much we sold? 2 lakhs plus 1,33,000 plus 67,000, that is 4 lakhs. Out of 4 lakhs, you reduce 20%, that is 3,20,000 equal to closing stock. So 10 lakhs minus 3,20,000, how much it is? 6,80,000 is the closing stock as on 2/10. 6,80,000 as on 2/10. Now in that 6,80,000, 3 lakhs we need to take out because 3 lakhs is purchased before 1 year. So only with respect to 3,80,000 we can take ITC. So on that, into 9% CGST and 9% SGST. This is with respect to the ITC on inputs. ITC on capital goods, already we calculated. Computers, on printers we cannot take, motorcycle also we cannot take, furniture and fixtures, exhaust fan. So if you total it, that will be the ITC on closing stock, which is with respect to inputs and capital goods. So with this, the answer is over with respect to question number 3. Now, they gave additional details also in question number 3. And what is the purpose of those details? So that is for question number 4. Have a look into question number 4. Keeping all the facts and figures of the above question unchanged, compute the GST liability of B&D company payable from electronic credit ledger under or electronic cash ledger as the case may be for the period covered under regular scheme. Now, for which month they are asking? We don't have the data related to complete financial year. We have only October month data. So take October month data. See, what is that we need to find? We need to find the net GST payable. As on 2nd October, we take some ITC on closing stock. What is that ITC that we take on closing stock on 2nd October? 82,800 and 82,800. These two we take as closing stock as on 2nd October. And this is under 18 months. This is the ITC as on 2nd October. Thereafter, from 3rd October onwards, we will be making some purchases on which the GST paid can be taken as ITC. So now you need to first find what are the purchases made after 2nd October on which we can take ITC. Now we have seen capital goods 1 point, air conditioner used in the office. So this we have taken, that is the purchased as on 15/10, means under normal scheme we have purchased it. So we can take this ITC. What is that ITC? We can take 36,000 we can take. Now say this. Already we have 82,800. As on 2nd October we have 82,800, and thereafter we have capital goods purchased during that month, air conditioner. How much it is? 36,000 divided by 2. Why we need to divide by 2? Because we need CGST and SGST. So I am taking CGST component, that is 82,800 as on 2nd October plus capital goods 18,000. See, whenever we calculate, we will divide by 2 so that we will put it under 2 columns, CGST and SGST. Then anything else? Capital goods purchased during the month? No. And any other services? Yes, services we received. GTA services. Whether during October month we received services? Yes. How much is the services that we received? 20,000. So on this 20,000, how much is the GST paid? 5%. On this 20,000, GST is 5%, that is paid under RCM. So therefore, 500 rupees will be added to the ITC with respect to GTA services. Also remember that 500 we need to pay, but for payment of that 500, we cannot use the credit. We cannot use the credit. That is GST payable under RCM. Then next, packing services also we received. Whether October month we received packing services? Yes, 30,000 rupees. So 30,000 into its general rate, that is 9% you take, you will be getting 2,700. Don't do divided by 2. That 9% itself is half, 2,700. Then whether we have any purchases during that period. We have any purchases during that period. We have any purchases during that period. So we don't know. We have the stock details. We have the stock details. So now we need to find the sales. We need to find the turnover. How to find the turnover? Closing stock, again same equation. Opening stock 10 lakhs plus purchases during the month minus cost of goods sold during the month equals to closing stock. Opening stock plus purchases minus cost of goods sold equals to closing stock. Now, what is that cost of goods sold we need to take? So here we need to take an assumption. What is that assumption? They have not made purchases during the October month. So what is the opening stock? 10 lakhs. What is the opening stock? 10 lakhs. Opening stock 10 lakhs. Add purchases 0 minus cost of goods sold during the month. We don't know. What is the cost of goods sold during the month? We don't know. But what is the closing stock? 3,60,000. Then what will be the cost of goods sold? So that is 10 lakhs minus 3,60,000. 10 lakhs minus 3,60,000 is 6,40,000 is the cost of goods sold. Now, this 6,40,000, which is the cost of goods sold, now I need sales. So on 6,40,000, which is cost of goods sold, you multiply 20 divided by 80, you will be getting 1,60,000 as the profit. 20 by 80. On cost it is 20 by 80. So this is profit. So therefore sales will be 8 lakhs. Sales will be 8 lakhs during October. During October, what is the sales? 8 lakhs. But in that 8 lakhs, during the October, what is the sales? 8 lakhs. In that 8 lakhs, already I have got a turnover, because in that 8 lakhs, which is the sales made during the month, with respect to which product? Product P. Same way, with respect to product Q also, we have got something. Now, with respect to product P, 8 lakhs is the sales during the month of October. In that, you take out these three. You take out these three. That is under composition scheme. So, 2 lakhs, 1 lakh 33 and 67,000, 4 lakhs. If you take out that, what is the sales of product P under, what is the sales of product P under regular scheme? 4 lakhs. What is the sales of product P? Sales of product P under regular scheme. Under regular scheme equals to 4 lakhs. What is the sale of product P under regular scheme? 4 lakhs. Then, what is the sale of product Q under regular scheme? Of course, we don't have to pay any GST, but for reversal of ITC, when I have common input services or common inward supply used for both taxable and exempted, I need to reverse. Na? For reversal, we need the sales of product Q. So, what is the sale of product Q? Sales of product Q under regular scheme. Under regular scheme. What is the sale of product Q under regular scheme? Same way, opening stock is how much? 2 lakhs. Add purchases 0 minus cost of goods sold equals to closing stock 1,20,000. From 2 lakhs, if you take out 1,20,000, you get 80,000. But that 80,000 into 20 by 80, you will give 18 profit 20,000. So 80,000 plus 20,000, 1 lakh will be the sales. But out of that 1 lakh, you take out these 3 sales. You take out these 3 sales. That is 1 lakh minus 3,000 minus 5,250 minus 39,250. If you take out 52,500. So 1 lakh minus this sales, you will be getting 52,500 as the sale of product Q under regular scheme. So on sale of product P under regular scheme, we need to pay GST. On sale of product Q under regular scheme, we don't have to pay any GST. Now see this answer here. Question number 4. 4 lakhs, you understood how we got sale of product P. On that only we need to pay GST. So 36,000, 36,000. On product P only we need to pay. How they got this? Already we did opening stock plus purchases minus cost of goods sold equals to closing stock. Cost of goods sold we aggregated to the sales, and from that sales we have taken out composition scheme sales. Then we got the sales under regular scheme. Then, and on GTA services, I told you we need to add 500 and 500. So that is 500 and 500. This is with respect to regular scheme, the GST payable plus ITC reversal we need to do. Why ITC reversal we need to do? Because we have taken ITC and that ITC is used both for taxable supply and exempted supply. So we need to do the reversal. That whatever we do reversal will be added to the liability. So up to this you understood. Now this 371 and 129 how we got, we will try to understand. First we will go to the ITC component. What is the ITC taken during the month? GTA services 500, 500 and 2,700 packing charges. And this is the ITC taken during the month. We don't have any ITC with respect to inputs because inputs are not purchased. Only input services are received. With respect to input services, we have 500, 500, 2,700, 2,700. This is the common credit, 3,200. This 3,200 common credit into this 3,200 common credit into exempted divided by total should be added to the liability. What is exempted? 52,500. Just now we computed Q. 52,500 divided by 4,52,500. This 371 should be added to the liability. That's where we got this 371. This month, see, rule 42 we are following here. Inputs we did not purchase, only input services we received. On that common, which is used for both taxable and exempted, so proportionately we are taking. Then 371 we got. Then what about capital goods? What is the capital goods purchased during the month? Capital goods purchased during the month is air conditioner, and even we have received some capital goods on 210. That capital goods also will be common. So we need to divide it by 60 and into exempted divided by total. What is the credit pertaining to capital goods, which we did already under previous 48,600, 48,600. See here, 48,600, 48,600 plus air conditioner 66,600 divided by 60 months, monthly ITC, rule 43, monthly ITC into E by F, exempted supply divided by total, that's where we got 129, that 129 also we are adding. So this is my GST liability minus ITC, how much ITC I can take. Now look into the ITC computation here. Look into the ITC computation. ITC on inputs and capital goods claimed on 210 is 82,800, 82,800. ITC on air conditioner 18,000, 18,000. Freight paid to GTA, packing charges. This is the total ITC. Using this 1,04,000, I can pay my liability. I have more liability or less liability, That is, what is the ITC that we have? Lot of ITC we have. But why 37,000 only? Why not 500? 500 rupees you have to anyhow pay in cash. So we can use only for payment of this 37,000, but remaining whatever is there, that is this 36,000 plus 371 plus 129. There is one mistake in the answer given here. That is, using ITC, that is while calculating 37,000, they have added this 500 also. While calculating 37,000, they have added this 500 also. Actually, this 500 should not be added. This is the error. This is the error in the answer. It should be 36,000 plus 371 plus 129. That is 36,500. So that should be the GST liability. 36,500. For using this 36,500, we can use the ITC 36,500. For using this ITC, we can do this 36,500 adjustment, and balance 500 we need to pay by cash. So therefore, we have used the credit balance for payment of this ITC. With this, the answer is over here. So all computations we did. And this is with respect to the turnover calculation. Already we calculated this turnover also. This is with respect to question number 3 and 4. So we calculated, now in detail I have explained to you. You take this question once and you practice. At your end, already this question is there. This is from the questions for practice given by ICI. So already it is there. You take this question once and you do the practice so that you will get an idea. And with this video is over. And we will be proceeding to the next video. And please don't scold me because of uploading the videos late. And I am trying to do it as fast as possible. And even I have looked out for a premises during this lockdown to go to that place and take the video lectures. So therefore, maybe by 5th April, you will be receiving a lot of videos, and we will try to complete it as much as we can. And the deadline what I am giving to you is April 10. Entire videos will be uploaded and you can watch those videos. Thank you.